What if I told you that some people live incredibly well, borrow enormous amounts of money, pass on millions to their families, and somehow never seem to pay much in taxes at all? Not because they're hiding money offshore, not because they're breaking the law, not because they found some shady loophole no one else knows about, but because they're using the system exactly as it was designed. If you've ever looked at your paycheck, seen how much disappears before it even reaches your bank account, and wondered how that can exist in the same country where billionaires pay lower effective tax rates than teachers, you're not imagining things. There really are two different financial worlds operating side by side, and most people never get shown how the other one works. For most of us, money feels very straightforward. You work, you earn, you get taxed. Whatever's left is what you're allowed to use. Every step is visible. Every mistake is expensive. Every gain feels fragile. But for the very wealthy, money behaves differently. It moves quietly. It compounds invisibly. It avoids friction. And over time, it starts to feel almost untouchable. There's a reason for that. And once you understand it, you can't unsee it. Most conversations about money start in the wrong place. We argue about tax rates. We debate whether the rich should pay more or less. We get stuck in these emotional political loops that never quite land anywhere. But the real issue isn't the rate. It's what actually counts as income. Because the system doesn't tax wealth. It taxes movement. It taxes money when it changes hands, when it gets realized, when it shows up as a paycheck or a sale or a transaction that leaves a paper trail. And the people at the top understand this better than anyone. They structure their lives so that their wealth grows without moving. That's the core idea most people miss. When you hear about someone worth hundreds of millions, your brain imagines stacks of cash, or constant spending, or luxury everywhere. But that's not how it actually works. Most of that wealth is sitting inside assets that quietly increase in value year after year. Stocks, businesses, real estate, private investments, things that don't show up as income unless you sell them. And as long as you don't sell, nothing is taxed. That's the first mental shift. We're taught that money exists to be used. Earn it, spend it, save it. But wealthy people treat money like something you park, not something you pass through. They buy assets that appreciate. Then they wait. And while they wait, the number on paper gets bigger, but nothing happens from a tax perspective. No forms, no payments, no attention. It's like watching a garden grow behind a locked gate while the tax system waits outside, unable to do anything until someone opens the door. Now here's the part that usually breaks people's brains. Because the obvious question is, how do you live? If all your wealth is locked up in assets you never sell, how do you pay for houses, cars, travel, or just day-to-day life? This is where the second layer comes in. Borrowing. Most people think of debt as a sign of being behind. Something you use when you don't have money. A last resort. But for the wealthy, debt is a tool. When you own valuable assets, banks don't see you as risky. They see you as safe, predictable, profitable. So instead of asking you to sell, they offer you loans. Loans backed by your assets. You don't sell your stocks. You borrow against them. You don't sell your business. You borrow against it. You don't liquidate wealth. You leverage it. And here's the key detail that changes everything. Borrowed money is not income. It's not taxed. If a bank lends you $1 million using your portfolio as collateral, that million shows up in your account clean. No deductions, no reporting as income, no immediate tax consequence. From the system's point of view, nothing happened. And while you're using that borrowed money to live, your assets keep growing. That's the quiet compounding most people never experience. Your portfolio might grow at 7 or 8% a year. Your loan might cost you 5 or 6%. And as it grows, your borrowing capacity increases. You refinance, you roll loans forward, you extend timelines. You never really have to pay it all back in the way regular people think about debt. The loan becomes permanent background noise. This creates a strange psychological effect. Money stops feeling scarce. Decisions stop feeling urgent. Time stretches. You're no longer reacting. You're choosing. And that's the real privilege here. Not yachts or private jets, but optionality. Now, if you're listening to this and thinking, that sounds fragile, you're not wrong. Markets can fall. Assets can drop. Loans can get called. This strategy isn't risk-free. It requires scale, diversification, and careful management. It's not something someone with a small portfolio can casually attempt. But here's the uncomfortable truth. The people using this strategy are often the least exposed to its risks because they already have so much margin. When markets fall, they don't panic. They don't need to sell. They wait, and the system is built to wait with them. Now comes the final piece, the one that locks everything in. Death. It sounds morbid, but it's essential to understanding why this works so well across generations. When most people pass away, their financial story ends. Whatever they built gets divided, taxed, or spent down. But for asset-heavy wealth, something very different happens. When assets are inherited, the tax system resets their value. All the appreciation that happened over decades disappears. If something was bought cheaply and grew enormously, the heir receives it as if it was bought at today's price. From a tax perspective, the past no longer exists. This is called stepped-up basis, and it's one of the most powerful wealth-preserving mechanisms ever created. It means that decades of unrealized gains are never taxed. Not when earned. Not when passed on. So when heirs inherit assets, they can sell portions of them immediately, pay off any outstanding loans, and walk away with the remainder. Without paying capital gains tax on all that growth, the cycle completes itself. Assets are bought, borrowed against, passed on, and the tax bill quietly dissolves. Now let's slow this down with a real-world scenario, because this is where the scale becomes clearer. Imagine someone who builds a successful business and ends up with $1 million. That already puts them ahead of most people. They could spend it, enjoy it, let it trickle away over time. Or they could invest it into assets designed to grow without producing much taxable income. Over 10 years, that million quietly becomes 2. No taxes yet. They borrow against it, live off the loan, keep investing. Over another couple of decades, it grows to several million. They keep borrowing, refinancing, rolling debt forward. They live well, not extravagantly, but comfortably, without financial stress. And when they pass away, their heirs inherit assets worth far more than what originally started the journey. The loans get paid off. The remainder stays. From the outside, it looks like generational wealth just appeared. But it didn't. It was engineered. And here's the part that stings for most people. None of this is illegal. None of it is hidden. None of it relies on cheating. It's simply inaccessible to people without significant starting capital, which is why the conversation about fairness feels so disconnected from reality. You can raise tax rates. You can argue about brackets. You can adjust thresholds. But as long as wealth isn't realized, it isn't taxed. And the people who understand this structure their lives accordingly. This is why income earners feel squeezed while asset holders feel insulated. The nurse, the engineer, the small business owner. They pay taxes every step of the way because their money has to move to exist. The wealthy don't move their money. They let it sit. They borrow around it, and they pass it on. Understanding this can feel unsettling, even discouraging. It can trigger anger. But there's another way to look at it. This isn't about copying the strategy. Most people can't and shouldn't try. It's about understanding the system so you stop blaming yourself for struggling inside it. So you stop thinking the problem is discipline or effort or intelligence. So you realize that financial stress isn't a personal failure. It's a structural outcome. Most people are trying to build stability in a system designed to reward those who already have it. Once you see that, something shifts. You stop chasing the illusion that earning a little more will suddenly fix everything. You stop comparing yourself to outcomes built on entirely different rules. You focus on building margin where you actually can. Because while you may not be able to buy, borrow, and pass on millions, you can still widen the space between panic and peace. You can build buffers, reduce fragility, create time, and that matters more than flashy numbers. The goal isn't to beat the system. It's to stop letting it convince you that you're broken. Progress doesn't look the same for everyone, and it doesn't need to. Once you understand how the game is played at the top, you're free to define success on your own terms. Calmer, slower, and far more grounded. And that, in a world built on pressure, is its own kind of wealth.